Hello, fellow Rebel Capitalists. Hope you're well. Let's go over gold, something that kind of nobody is talking about recently other than just the gold bugs. And that is usually a time when you want to consider buying. We always like to, as Rebel Capitalists, we always like to buy things when they're cheap, sell them when they're expensive, but also really consider things when they are completely off the radar and relatively unloved. So let's go into a chart of gold to start here, CNBC, and we see that it's up to 1781. And we peaked out in the last kind of mini cycle, if you will, back in March at over 2000 and pretty much gone straight down since then. I'm no technical analyst, but I know that when you have a downward trend like this and the up move breaks the trend, that's a good sign, or the trend line, that's a good sign. So I think the trend line was, just ballparking this 1716 right around there. We're at 1781. So maybe on a pullback, you could see it continue to go higher. But as you guys know, I like to start my own investment process by looking at the commodity long term adjusted for inflation, so I can determine whether or not it's quote unquote cheap right now. And I know that it could be cheap relative to this or relative to that, but I don't like to start there. I just want to begin with the absolute basics, right? So let's go to a chart of gold, historic long term, adjusted for inflation. And this goes, stupid ad. This goes back, oh, wow, 1920s, 1915. Okay, we're on the gold standard, but 1971. But even after 1971, you can see that, if we want to look at an average, we're right around 1,000. So just doing the super simple math, and that's usually what I do. It's not rocket science for my own portfolio, at least, is I would say that anything under, I don't know, call it $800, adjusted for inflation, is cheap. And then anything over, call it maybe 1,500, is expensive. So if I was just buying gold as a speculation, I wouldn't buy now. And I'm not saying it's not going to go up. I'm actually pretty bullish on gold over the next probably, well, the long term for sure, even buying at this price. But I don't buy gold as a speculative asset. I don't buy it to get rich. I just buy it as insurance. So I pretty much buy at any price. It doesn't really matter for me because I always just allocate 10% of the portfolio to physical gold, or as close to physical gold as I can get based on my travel schedule and kind of where I am in the world. But it doesn't mean that I wouldn't consider another speculative asset that could be relatively cheap that is a derivative to a certain degree of gold. And what am I talking about? Talk about the gold miners. So I would not be in the camp that would say, oh, gold is cheap now because of whatever, M2 money supply, what the government's going to do, and you have to load up 100% of your portfolio in gold right now because it's going to 5,000 or whatever. It might go, and I can definitely see an argument for that, but that I never try to figure out price direction. That's not the game I play. Not that it's bad. It's just not the game I play. I just sit here and say, okay, under 800 cheap, I'm going to buy. Over 1,500 expensive, not a buyer. I'm a seller, in fact. If I looked at this as strictly a speculation, like uranium as an example, or like the gold miners themselves. So to be clear, I look at gold as insurance, so pretty much buy at any price. But although gold's not cheap right now, adjusted for inflation, I think there is a derivative that's the gold miners. So let's go over to a chart, just using the GDX as a proxy. We can see that going back to 2007, right around $40, and it dips way down the GFC, which you would expect because of Lehman. More on that in just a moment. And then we see it go up to its past high, which was what, 1,800. I'm talking about the high in gold. And the GDX got to about $65 and it crashed down with this big bear market and it went up slightly, but now it's really down almost. I mean, just a while ago, we were darn close to where we were at the bottom of the GFC. Wow. Okay. And we were right near where we were at the bottom of the cerveza sickness. Wow. I didn't even realize that prior to going live. That's a big deal. Now, 2016, it really, really took a beating, but I think that was more because of the fundamentals of gold. And now the fundamentals of gold might be a little bit better, although it's still expensive. And this was definitely a result of liquidity crisis, where gold just plummeted because of Lehman, because the big pools of money had to sell whatever was on their balance sheet that had a bid. And same thing happened here during the cerveza sickness. So this was in a backdrop of what was going to be more, quote unquote, money printing, to use that term very, very loosely. But especially in 2020, expansion of the M2 money supply based on what was happening behind the scenes and what created this liquidity crisis in the first place, whether it was the GFC or the cerveza sickness in 2020. So as a result, the government steps in to do all these things that are very bullish fundamentally for gold, and you see the gold miners absolutely rip higher. And although gold is still relatively expensive, the miners are getting very darn cheap because of inflation. Their input costs are going up and up and up and up and up. The price of gold is kind of staying the same. So if their input costs are going up, price of gold stays the same, most likely the stocks go down, which, in my opinion, gives us potentially a great buying opportunity. And the one area where I would be concerned is if we had another liquidity crisis, which I think there's a decent probability of that, especially if you watched the last live stream and have been following all the coverage on the yield curve and all the red flags. But the good news is, especially down, and again, I'm just using the GDX as a proxy. I'm not saying buy the GDX or anything like that. Just using it as a proxy for whatever gold miner you like. But boy, I tell you what, especially when it got down near 22, I mean, definitely on the watch list. That is for sure. And I'm very interested in miners when the GDX gets down around 22. My goodness, anything under 20. And that would be, I think, a gift. That would be awesome. So, Josh, go ahead and mark this down for the model portfolio that we have in Rebel Capitalist Pro. And that let's just keep an eye on the GDX and see if it
price
gets
would you
below.
want to see it at?
What's that?
What price would you want to see it at for
Below
you
20.
to start buying? 20?
Below 20. And it's not like I'd buy the GDX. I'm just using that as kind of, again, a proxy to put on the watch list. So if it gets under 20, we know that as a whole, miners are cheap, and then we need to start, potentially buying or trying to figure out, if we are going to buy, which specific miners do we want to own. You got that?
Yes.
Okay, cool. So that's kind of my take right now on gold, guys. Just as a quick summary to make sure that we're all on the same page, gold itself, still expensive. And if I was owning it just as a speculation, I would not buy it here. But I don't own it as a speculation. I own it as insurance. So I pretty much just buy it at any price, just accumulate the position and really kind of never sell, just as an insurance policy. But as far as the miners, they're getting very, very interesting. And especially where they were, call it a week or two ago. Hopefully they get back down to that level and even lower, because if they get to a level where they were at the bottom of the cerveza sickness or, back to the GFC, that would give me quite a bit of confidence to start building a position. Not that I'd go all in, because again, I'm very concerned that they're going to have a liquidity crunch that would make gold sell off even farther. But if gold miners are already down near that level of the last two major liquidity crises, that would, again, give me the confidence to just start nibbling and building that position, and then keeping some dry powder in case we get that liquidity crisis. And if we don't, you've already got a small position. And if we do, then bam, you can go ahead and take advantage of an even cheaper price and then hold it for the long term and just ride it back up to a point where the miners themselves get quote unquote expensive again. Then you just go ahead and sell and go into the next asset on the speculative side of your portfolio that you think is cheap. Buy low, sell high. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.